that million would have turned into 5.3 billion. You would have gotten, for every dollar you put in, you've gotten over $5,000.
Do you know what Warren Buffett's unmatched stock buying and selling strategies are? Do you know how Warren Buffett became a titanic investor and achieved success? Explore the world of investment with us as we delve into the illustrious Warren Buffett's unmatched stock purchasing and selling tactics. Discover the strategies that Warren Buffett uses to achieve success, from his distinctive understanding of economic trends to value investing concepts, by following us on YouTube. Just subscribe to our YouTube channel and hit the bell icon to get notified every time we upload a video on our channel. And don't forget to like, share, and comment. Come along on this informative adventure with us as we discuss the tried and true methods used by Warren Buffett, one of the greatest investors of all time. Regardless of your level of experience, these tips are priceless for anyone trying to make their way through the confusing world of stocks and investing. Value investing, which Benjamin Graham pioneered, forms the foundation of Warren Buffett's investment philosophy. Buffett's long-term outlook, which drives him to invest in superior companies with sustainable competitive advantages, is a fundamental component of his strategy. This approach, sometimes known as a buy and hold strategy, entails purchasing stocks and holding onto them for a prolonged period of time. The foundations of Warren Buffett's stock purchasing and selling approach include patience, value investing, and an emphasis on long-term fundamentals. Here are the main elements of his approach. 1. Investing in value. Buffett is a fervent supporter of value investing, which Benjamin Graham originated. He looks for stocks that are being sold for less than their true worth. To ascertain a company's actual value, this entails evaluating its growth prospects, competitive position, and financial stability. Buffett's long-term outlook, which drives him to invest in superior companies with sustainable competitive advantages, is a fundamental component of his strategy. This approach, sometimes known as a buy and hold strategy, entails purchasing stocks and holding onto them for extended periods of time. 2. An edge over competitors.
Well, but you gotta be careful about what you compete in. It's a good thing I don't have a competitive spirit in chess or or football or anything like that. No, I'm an observer there. I enjoy watching things like that, but I try to keep my competitive spirit in a game where I can win.
Strong economic moats. A company's ability to fend off competitors and sustain profitability over the long run are what Buffett seeks out in investments. Regulatory benefits, network effects, cost advantages, and brand strength are a few examples. Buffett seeks to gain from the company's capacity to produce steady and increasing earnings over an extended period of time by investing in those with enduring competitive advantages. 3. Long-term investments.
I was always coming up with more ideas than I had money, so I had to sell whatever I liked least to buy something new that just was compelling to me. And for a long time I was in that mode. And now our problem is we have more money than ideas.
Long-term investments are Buffett's favored holding duration. In fact, he frequently states that his ideal holding period is eternal. He thinks that investments should be allowed to grow over time and that compound interest has great potential. He can better weather short-term market swings and concentrate on the inherent worth of the companies he invests in thanks to this perspective. 4. Evaluation of intrinsic value.
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is.
Buffett carefully determines a company's inherent value before investing any money. This entails projecting future cash flows that the company will produce and then discounting those cash flows to their current worth. If the market price is less than the inherent worth, the investment can be deemed appealing. 5. Having a business understanding.
We're almost always a buyer of stocks, and we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down.
Buffett highlights the value of making investments in companies that he is well versed in. This entails steering clear of businesses with intricate business plans or sectors he finds confusing. His approach is to concentrate on markets and companies that he can reasonably confidently analyze, forecast, and assess. 6. Control of quality. Buffett believes that a company's management team makes a big difference. He seeks out executives with a track record of making wise business decisions, competence, and honesty. A strong management team is thought to be crucial to a business's long-term success. 7. Avoiding market timing or preventing short-term market fluctuations.
What's going to happen in a day or a week or a month or a year even? I've never felt that I knew it, and I've never felt it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
Buffett cautions against letting short-term market fluctuations, transient market swings affect you. He reduces the effect of market volatility and concentrates on the underlying fundamentals of the companies he invests in by hanging on to equities for a long time. Buffett suggests staying away from market timing. Rather, he advises investors to maintain discipline and resist being influenced by transient market swings. Regardless of market volatility, he employs a patient and fundamentally based approach when investing in firms. 8. Easiness and reliability. Buffett likes companies whose operations are clear-cut and dependable. He stays away from businesses that have unclear futures or are highly dependent on unpredictable variables. His desire for simplicity fits with his objective of making confident and well-informed investment judgments. 9. Seldom sold out.
In terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for them. I mean, if somebody offers us 3 times what something is worth at See's Candy, the Buffalo News, Borsheim's, whatever it may be, we're not going to sell it. I may be wrong in having that approach. I know I'm not wrong if I owned 100% of Berkshire, because that's the way I want to live my life.
It is well known that Buffett is reluctant to sell equities. He often hangs on to a high-quality business with a solid competitive position and dependable management for an extended period of time. He thinks that investments should be given time to reach their full potential. 10. Compounding effect.
Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock.
The power of compounding is something that Buffett emphasizes a lot. Long-term stockholders can reap the benefits of capital appreciation and a compounding impact of reinvesting dividends. This method fits nicely with his long-term growth tactics, used letting investments develop and optimizing returns. 11. Reducing transaction costs and taxes. Buying and selling stocks on a regular basis might result in higher transaction costs and tax consequences. Buffett is renowned for his frugal investing methods. By holding onto assets, he lowers capital gains taxes and the costs related to trading frequently. In conclusion, a number of factors, including the power of compounding, a wish to avoid cyclical market swings, a reduction in transaction costs and taxes, an emphasis on high-quality investments, and a dedication to patience and discipline in the world of investing, have led to Warren Buffett's belief that stocks should rarely be sold. His rise to prominence as one of the most reputable and prosperous investors in history has been largely attributed to this strategy. Value investing, an emphasis on economic moats, a long-term outlook, a deep understanding of firms, and a concentration on quality management are the main components of Warren Buffett's stock purchasing and selling strategy. His achievement in becoming one of the most well-known investors globally may be attributed in large part to his methodical and patient approach and other buy-and-hold approach.